episode 33 of Top of Mind with Consilio Wealth. On today's episode, we're going to be talking about the dollar strength against other foreign currencies. Hao has some travel plans coming up here soon, and he's going to discuss how he's hedging his currency bets here. The Fed met this week, and they said that their intention is to hike more, but not yet. So we thought we would unpack some of their language. Something that's been in the news last week, just for a quick headline, and then not, the government shutdown. Government's supposed to shut down next Friday. We thought we'd unpack that a little bit because it's not in the news right now. And finally, we will roundtable the UAW strike, updates on their negotiations and what we think is going to happen there. We actually even dove into Ford and Stellantis and GM stock, and we had some interesting things to talk about there. Today is September 22nd. It is 9:44 in the morning. It's Friday. It's a beautiful day today. And I'm joined, as always, by Mr. Hao Dang. Hao, thanks for joining the pod today.
Hey, Chris.
All right. So let's start with dollar strength. The U.S. dollar is enjoying its longest winning streak in nearly 9 years. Hal, let's talk about this for a minute. Can we break down what does it mean when the dollar is strong against foreign currencies or weak against foreign currencies or strengthening or weakening? Can we break that down for our listeners?
Yeah. I think we talked about strong dollar, weak dollar, and the term strong versus weak is pretty much a misnomer. It's just describing the direction of the U.S. dollar relative to another currency, right? So a strong dollar has benefits for spenders who earn in U.S. dollars, right? So if I'm spending and I'm buying something from Japan or China or Europe, that's going to be relatively cheaper if the dollar is strong against those currencies. But think of it from a point of view of a U.S. company, though. What if I'm selling something in Japan, Europe, or China? Tesla's a good example, right? My prices most likely have to come down, or I'm going to price myself out of the market. Tesla has had to reduce their, the cost of their cars, the Model 3 and the Model Y in China, several times this year alone, just to keep their volume up. So that's not a benefit to the U.S. dollar strengthening for a company. So if the dollar were to weaken, Tesla's overseas would suddenly be cheaper to buy, relatively speaking, for foreign consumers, right? So that's a huge benefit for businesses for a weak dollar. So what I'm trying to establish is there's no good or bad with strong or weak, other than depending on what side you're on, right?
So an example that I'd share is when the dollar is stronger against foreign currencies, your money goes further when you travel abroad. So We've been saying for a while now, it's a great time to go to Europe, great time to go to Canada. Our dollars are buying more of euros or Canadian dollars, for example, than they did even just a year ago. And so that means that the relative prices when you get to that country are less because you can buy more of their currency.
Exactly. But again, tourism is only one small piece of it, right?
Totally. So, yeah, totally.
I know I'm addressing that because we have quite a bit of chatter last year where the dollar was gonna not be the world's currency anymore, and people were, trying to bury the dollar and say it was weak because we borrowed too much, we raised rates too high. Those headlines or those people don't know what they're talking about, because we're talking about trillions and trillions of dollars of money moving, and with higher interest rates, and we're the country that's risen rates the fastest and the highest, right? And you look at Japan, where they've actually kept their rates at negative, and that means if I'm a saver, who doesn't matter what country I live in, I'm probably going to save my savings in U.S. dollars because it's paying about 5%. Japan's paying a negative 0.1%. So my dollar is getting a lot more demand as a U.S. citizen versus the Japanese yen at this very moment.
So this is this quote here that you have in the doc. It actually says that the U.S. dollar rally was fueled by concerns that the dollar might be losing its status as the world reserve currency. Do you think that that is an inaccurate statement? Like, what's fueling this if not? And by the way, that statement doesn't actually make sense to me, that the dollar would become stronger against foreign currencies if it loses its status. But regardless of that, do you think that statement is inaccurate? And if you do, what do you think is causing the strengthening of the dollar here in recent time?
Yeah, it might be overly simplistic because it's hard to explain currency movements as I described, because stability of the government, the growing economy or shrinking economy will have impacts on dollar demand or currency demand depending on the country. For it to strengthen simply because the headline says the dollar was losing its status as the world's currency makes no sense. I know at a time when last year what Russia, China, and Saudi Arabia tried to combine the forces and reestablish a new world currency. One, as a world investor, what do you think about the stability of Russia? What do you think about the stability of China, right? And in a cesspool, really, of countries that are the poster child of instability, Saudi Arabia of the three seems to be the most stable, and they have a lot of warts too. So that the fact that the dollar strengthened on that news doesn't really make sense to me. But I think it's the dollar strengthening simply because our interest rates are higher than everyone else right now.
And therefore, people are buying our bonds?
Yeah, buying our bonds because they're getting a higher rate of return. Yeah, higher yield.
Do we have the highest interest rates in the world right now?
Relatively speaking. So
relative, probably Venezuela's higher, right? Because they're
exactly.
maybe 50% or something, 20%.
Yeah,
but
yeah, I could get you a Argentinian bond for like 50% yield.
Yeah, right.
Yeah. Yeah, so it's all that a lot. Stability has a lot to do with it, and economic growth has a lot to do with it. But interest rates have a lot to do with it as well. So to attribute it to a headline doesn't really make sense.
But didn't the U.S. debt just get downgraded by the major rating agencies?
For sure.
And what was cited there was instability of governments and inability to make decisions. So when that happened, how did that play a role in dollar strength or weakening? Or when that happened, did that change this trajectory at all?
Yeah, it did and didn't. I think it kind of shifted everything up and down because the U.S. honestly isn't the only country with debt problems, right? And if the U.S. is having debt problems, it's going to have a ripple effect to other countries, right? Canada, Mexico specifically. So if you're downgrading U.S. debt, you're implying that anyone that does open and free trade with the U.S. is probably going to have to downgrade as well because they're so reliant on, this ecosystem that we've built, particularly through NAFTA, through trade agreements with Europe, things like that.
Interesting.
Yeah.
So you have a trip coming up here. You're going to Japan.
In April, yes.
And I think that's going to be awesome. I'm excited to hear about it and then maybe follow you there. That'd be cool. But so you just told me as we were prepping for the show here that you're buying Japanese yen right now. Could you just unpack for our listeners, why are you doing that now in advance of April, and how are you doing it? And I'd just love for you to kind of expand on what you're doing.
Yeah, taking the dollar strength in action, right? So whether Japan or if we're going to Europe, it would probably be the same effect right now, where the euro is trading nearly 1-to-1 to the dollar. Typically, it's about 140-to-1.
Yeah.
Where you would need a dollar would buy 1 divided by 140. So a dollar would buy a lot less euros than it does today. Same thing with Japan. Right now, Japan is trading in the yen, and it trades 140 something yen to $1.
Looks like 148, so call it 150.
Yeah, And previously, you'd get a lot less yen for each dollar because, one, the Japanese currency, believe it or not, over the last 30 years has been persistently strong, and that's because they have had a lack of inflation, right? So they actually had deflation. People have been moving their money there for stability, right? For a lot of different reasons, even though their interest rates have been relatively low to negative, and it's negative at this point. So traveling, what we've been doing is going through an app called Wise, which they allow you to convert really to any currency. But obviously the currencies we're talking about are US dollar and yen, right? So we're not going till April, but the yen hasn't been this low in the last 10 months. So the app allows you to buy with US dollars, Japanese yen, and park it there until you're ready for your trip. And they send you a little card that you can go to ATM in Japan, pull out yen, or use it as a debit card, really.
That's pretty cool.
Yeah, and it's kind of a way to hedge.
Do they take a spread on it then? So like if I see the current rate is 1 to 148.26, do they do the conversion at 145 or 140 or something? Or how do they make money?
Yeah, that's why I use them, because if you go to an airport, the spread's about 8%.
It's killer, yeah. No fee. Yeah, right.
No fee, but they're taking out of your exchange rate.
Yeah.
So yeah, no exchange rate spread other than a transaction fee, and we pay about 0.5% per transaction.
So 0.5% on total money moved in.
Total money moved, yes.
But the exchange rate is the market rate.
Correct. Correct. So the trip's in April, and that's 7 months away. We're buying and treating it like a savings account for the trip, because if the dollar weakens against the yen, your purchasing power goes down if you had no yen, right? Because a lot of travelers do, and it makes a lot of sense. A lot of travelers do buy their foreign currency as soon as they land. But for me, we booked the trip, and now it's like 7 months of currency movement, and we don't want to have negative exposure to that. So that's why we're slowly adding to our trip savings via Japanese yen.
Does it pay you anything for holding the yen there? Like, do you get an interest rate on it?
No. But the exchange rate does move, which is interest rate sensitive. So in a way, there is some kind of compensation for that. But yeah, you're right. So if you think about it, and the flip side is, instead of buying yen for April, we could just put that in a high yield savings account, earn 5% up until that trip point. Theoretically speaking, those two should balance out. They should, but again, currency is messy, it's unpredictable, right? And that's really what the interest rate impact is, right? If I can earn 5% in US dollars, why not keep it in US dollars until we're ready for the trip? And that way, when we're ready to exchange, it would essentially be equal to what I'm doing now.
Wise is pretty cool. I hadn't heard of them.
Yeah.
According to Wise, it says, with Wise Travel Money Card, you can get up to 87% better exchange rate and lower fees than your bank. I'll have to look into this. This is cool.
Yeah, we used it for Mexico, but what Mexico does is actually pretty smart. Is not very smart for tourists. A lot of the tourist cities peg their prices to US dollar.
Right.
So the US peso mix changes. All they're doing is adjusting their price.
Mm-hmm.
So they're just raising the prices that the peso weakens.
Yeah, you don't get. You certainly get U.S. prices when you go to very touristy areas in Mexico. You know, you're paying $16 for tacos, right? But then if you can get into the away from the touristy areas, then you're getting
the true
kind of the benefits of
value.
moving.
Yeah,
exactly, traveling into a lower cost part of the world. Okay, this is interesting. I just want to give a 5-year rough history for our listeners of $1 to Japanese yen, so the conversion rate. So if I go back 5 years, so this is like end of 2018, right? So call it September of 2018. $1 US would buy you 114 Japanese yen. That trended downward all the way until really the end of 2020. So January 2020. It was just a hair above 100. So $1 bought you 100
Yeah.
Japanese yen. Today, that's 150. So it's gone up 50% after declining, 15% since 2021. So all of 2022, it went up about 15%, so 1 to 115, and then it just spiked like crazy all the way to 147 in October. Do you know what happened between February of 2022 and October of 2022? It went from 115 to 150.
Yeah,
What
a couple
happened?
of things diverging there where our interest rates are going up pretty, 50 basis,
lot.
half
Yeah.
a percent at a time, right? Big jumps. At the other side of the pond where Japan is, their interest rates they have curve control policies versus our Federal Reserve raises the overnight rate. They actively buy and sell at different parts of their curve. So they've been actually keeping theirs low because due to population concerns, right? They have an aging population, no immigration, so their population has been steadily shrinking for the last however many decades. So they have zero growth, therefore zero inflation. And that's a problem is they've tried to spur spending for the last few years, and they did that by lowering savings rates to negative. So if you have money in the bank in Japan, you're actually losing quite a bit of money.
Right.
But it's keeping up with inflation, right? In their case, deflation. So the Japanese Bank of Japan, which we do keep an eye on, they do have market moving interest rate policies. But yeah, what they've done recently was send their rates negative while we were raising rates.
And that's
Different countries have
caused
different problems, yeah.
their currency to weaken against ours, or our currency to strengthen against theirs,
Correct.
which is what this spike happened over
Exactly.
8 months.
So all the money went to U.S. because we were paying, what, at the time, 3.5%, 4%. That's better than negative whatever they were paying.
Okay, so then it kind of went crashing down from October of 2022 to about January of 2023, so call it 2 or so months,
Yep.
all the way back down to 130, and now it's back up close to 150 again. What happened there when it crashed and then it recovered?
Yeah, it's really the U.S. movements. We headed into the year thinking that rate hikes were done, inflation's dead, right? And then all of a sudden, yesterday or Wednesday, we had another Fed announcement saying we're going to pause the September hikes, but we're putting back on the table another hike this year. But earlier during the dates you mentioned was the market was implying that the hikes were pretty much done for the year, or we had 2 more hikes left in the year and then we were done, right? I can't remember what our forecast was.
Yep.
But we were pretty much at the end of the road. So that's what really shifted back strength towards the Japanese yen, or really to other foreign currencies, because the market was pricing ahead that the Fed was done.
Interesting. Got it. Okay. Well, so for everybody listening, we'll timestamp this. House started buying Japanese yen in August. Let's call it about 145. Was
This
its
is my
exchange
529
rate.
story. Yeah.
Yep, this is your 529 story. We're living it live on the air. And let's see where it's at next year in April when you're going. And let's see if you made money on this.
Yeah, or in our case, just not actively lose money. But
Totally.
yeah, you could do this in a different way. Just park your money in U.S. dollars, high yield savings account, and then go travel. It might be a lot less headache because you would be earning whatever percentage you're earning here.
I guess you're let's say that the high yield savings account's paying you 5%. Well, if the currency moves more than 5%,
Yeah.
against you, then you would have done better actually buying that currency. So it's an interesting hedge. I like it.
Yeah, and I think
somebody
it's
like you would do that.
educational.
I
Well,
think
yeah, it's an
normal
educational
people
thing.
wouldn't, but you would
No,
do that.
they shouldn't. I spend way too much time in the Wise app. Again, we don't have any sponsors, but especially not Wise. But I do recommend them for foreign travel.
That's cool. All right. Okay, let's move on to, so you just commented briefly on the Fed, and I just wanted to quick roundtable that. So the Fed came out. They said that they are going to raise possibly one more time, but not right now. Anything else come out of that meeting or anything worth noting on their commentary?
Yeah, so to be clear, they did not raise rates. The market did it for them. They came in the meeting, the 10-year treasury was about 4.25%. Now it's at 4.5. So the market said, we're not going to really wait for you. If you're signaling rate hikes, we're going to just go ahead and price it in.
That's what we refer to all the time as pricing in, by the way. So the Fed, the market tries to predict where the Fed's interest rates are going to go. And that's why we say if the Fed raises, and we've been saying this for months now, as the Fed continues to raise, that doesn't necessarily have a direct impact on interest rates. It will on your bank account, or a very short term, like CD rates will move with the Fed because they're very short term credit. But mid and longer term credit, say 5-year, 10-year, et cetera, that tries to price in, which means that when the Fed raises, it actually might not change at all.
Exactly. And right now, the 2-year is showing pretty good deal at 5.1%. It is lower than a 1 month, but I'd rather lock in 5.1 for 2 years versus 5.3 for 1 month, right? So when you're thinking about CDs and high yield savings, those are very, very temporary. Mm-hmm. And I promise you, we're going to be talking about the good old days when we had 5% interest rates in 2023. It's just, I think we look back at 2017, 2018 and think about relatively higher rates.
Yep.
And they just don't last.
Yep. No kidding. Let's move to the government shutdown. I think it's important that we talk about this today because I saw this in the news maybe a week ago, maybe 2 weeks ago. It was a little article that said, hey, government might shut down. Nothing. And then this deadline is actually next Friday.
Yeah.
So what the heck's going on? Again, I thought we passed this, right? We raised the debt ceiling. What's going on now? What are the negotiations, and why do things seem to be stuck again?
Yeah, we've had a lot of market moving fundamental moves, right? Or news. This happens to be possibly the second one. What's happening is the Republican caucus is at a standstill. California's own Kevin McCarthy has very loose grip on his party. There is some pretty extreme viewpoints on the right. Again, there's extreme viewpoints on the left, but the right now is really trying to flex their muscle and demanding very sharp spending cuts. And with a Democratic president like Joe Biden, most likely isn't going to sign anything with the amount of proposed cuts, especially to social programs and things like that. So that's where we're at a standstill. They're threatening not to even vote on next year's budget, which is, as you said, Chris, like October 1st. I think we need to really look at that date as a D date. And if government shuts down because there's no agreement, we're going to see a lot of services go away and a lot of federal workers get furloughed.
So it's going to be a typical thing where essential workers remain on the job and everybody else is on a furlough. Is that the extent of this?
Sorry, what was that?
So this is kind of a typical shutdown where essential workers remain on the job, but everybody else gets furloughed. So city services and these kinds of things get furloughed, but your trash will still get collected, that kind of stuff.
Yeah, correct. Your mail still gets delivered. We still have border security, military operations, things like that. It makes you wonder what was really essential or really not. But at the same time, those workers, a lot of them will actually be working without pay in some cases, depending on what department they work in. So what they do is just kind of they earn their paycheck, but they don't get paid.
They don't get paid, and they get a lump sum.
Yeah.
Interesting.
So imagine that, right?
Imagine that. All right. Well, we'll update that in a couple of weeks on our next recording because I'm sure it'll be top of news here in a few weeks because these negotiations are happening now. And to Hao's point, it seems like they're going nowhere. Both parties are holding out, saying no, and it seems like they're not very, very close at all right now. So, getting one party to sign the other one's deal, I mean, it's just a non-starter at this point.
Yeah.
So we'll see what materializes here in the next 2 weeks, roughly. Let's move to our final topic today, the UAW strike. Lots of strikes in the news. The writer's strike, UAW strike. Let's just unpack the UAW strike, because this one I think is pretty interesting. You had some interesting data as well on Ford and GM and Stellantis, which, by the way, Stellantis, if you haven't heard of them, that's like the parent company of Jeep.
Chrysler Jeep.
Chrysler Jeep.
Yep.
It's like, why isn't it called Chrysler? Well, Stellantis is kind of like the umbrella company. So that's who that is. I'll let you kick us off here. Obviously, there's been a strike. What's going on? What are the negotiations? And what are the workers asking for?
Yeah, and this is probably the third big market-moving event that's happened in the last few weeks, or since the last episode. So UAW represents about 150,000 workers across the three automakers, but they obviously represent, their union represents a lot more workers at a lot more companies, but these are the big three in the headlines. What their strike is very unique. It's targeted. So if you're a striking union worker, you're not getting paid, but they targeted supply chain important factories, so they don't have to strike the entire union, right? So, but when these supply chain hubs aren't producing, that idles other factories.
Right. Other people can't get work done.
They can't get work done, but the key is they can still go to work. They're just twiddling their thumbs at work, collecting paychecks from these companies versus dipping into the strike pool. Because when you go on strike, you build up this fund, the slush fund, to pay the striking auto workers, just so they're not earning anything, right? So that's why they've started these targeted strikes to have this ripple effect at other factories and still maintain their paychecks from Ford, Stellantis, and GM.
Interesting. That's a lot of leverage.
Yeah, novel approach versus taking all 150,000 workers off payroll.
I see.
But the union would have to pay the striking wages.
So let me read this, because I think this helps explain what you just said. So it says the selected plants that were on strike produce highly profitable vehicles for the automakers that largely continue to be in high demand. So think like Ford makes trucks. That's their most profitable thing. The truck plant is on strike. So about 12,700 workers across Stellantis, GM, and Ford will be on strike at those plants in total. However, the UAW represents 146,000 workers across, again, those three companies. So call it 10% of those workers are on strike, but those 10% are so critical to profitability and the beginning of starting those cars. And now that makes, 130,000 people at some point just kind of twiddling their thumbs.
Yeah.
Wow.
But their goal is to have them remain paid, right? Or stay on payroll for that time being, which striking is expensive for the union as well, right? I know they're super disruptive to the economy, but unions have to pay for striking workers. But if a fraction, as Chris mentioned, the fraction of the numbers are actually striking, you don't have to dip in your slush fund too deeply.
Yeah, it says targeted strikes at select plants is somewhat unique, actually. That's interesting.
Yeah, that's a new approach that we've seen. But again, I don't think we're going out in support or against unions. It's just kind of trying to report what's happening here.
Yeah, for sure. Yeah. So, okay, here's what they're asking for, which is interesting. Key proposals from the union have included 40% hourly pay increases. That's over 5 years, right? 4 years?
4 years.
4 years?
Yeah,
okay,
40% of it this year.
Increase. So 20% this year, and then the rest in the remaining 3.
Staggered over the,
They're also asking for a reduced 32-hour work week, a shift back to traditional pensions from 401k plans, the elimination of compensation tiers, and a restoration of cost of living adjustments, among other items on the table, which are including enhanced retiree benefits, enhanced vacation and family leave benefits. You had an interesting point here on the 40% and how they came up with that. Could you unpack that for our listeners? Why are they asking for 40% more money?
Yeah, and I guess this is like a union jump into the future where they're just doing some really novel things. So this one was specifically targeting GM's CEO Mary Barra. Her her pay increase was up 40% since 2019 as well. So the last 4 years, GM CEO has made 40% higher wages. That they're demanding the same thing as a result.
So UAW has pegged its 40% pay increase demand to the increase in CEO pay. It does say at the three automakers here, but but Mary Barra was paid $29 million last year, which is 34% more than she received 4 years ago. Mary comes out and says, hey, 92% of my compensation is in stock and options that are tied to company financial performance, not pure salary, and that her base pay is unchanged since 2019. But I guess we don't really know what those tiers are and how those shares
Sure.
like release in terms of strike prices. But you had some interesting information on how GM has actually not performed very well in terms of their revenue growth, and then also their stock price compared to the other two. So let's unpack that for our listeners.
Yeah, maybe Mary Barra should have stayed away from her stock compensation being tied to financial performance, because if I were we're looking at it objectively, she probably shouldn't be the CEO of GM, let alone maintain this pay raise or pay rate. There's nothing in the stock performance or the financial performance, for that matter, that justifies really any pay increase for her.
But your point is, or their point, or I guess her point, is that she's being awarded shares, but they're options or they're vesting based on company performance, and if the company's not performing, she doesn't get paid.
Yeah.
Right. So I guess she could be awarded, say, $30 million of stock, but maybe it doesn't actually go through if the company doesn't hit milestones, right?
Exactly, and I think that what makes this kind of muddy with the stock compensation, because one, GM is up 10% over the last 3 years relative to the S&P is up 40%. So right there, the stock performance itself has not really held up its end of the bargain, right, for a potential pay raise. So if the stock is up and you have 10,000 shares awarded to you, right, that the value of the stock option would go up justifiably because you've created value for shareholders and for the company, right? And that's really not the case, as GM has lagged the S&P pretty badly. And again, we didn't just look at GM, right? Look at Ford and Stellantis during that same time period. Ford is up 100%. Stellantis is up 123% during that same time frame. So I think we could justify Jim Farley's, the CEO of Ford's, pay raises if there was a true tie to stock performance, right?
Mm-hmm. Mm-hmm. You're also saying here that when we look at GM's total revenue and net income and sort of their performance, their total revenue over that same period, it's up 26%, it looks like. Total net income is down 36%. So they had slight increase in revenue, but they're spending more money.
Yeah, they're spending more money, and they're becoming a lot less efficient with their bottom line, right? So the bottom line is actually shrunk by 36%. So looking at all the objective numbers, Mary Barra does not really deserve, stock compensation or not, that kind of a pay raise.
Yeah, interesting. Different, looking at this in different time periods too. I mean, there was a period where GM was dramatically, it was up more than 80%. When the market was up, 40. So I mean, there was a period where it was dramatically outperforming, but then it looks like starting in January of last year, it tanked.
Yeah,
it tanked for 6 months, and then it's been basically flat ever since then. And we all know what's happened with the S&P since then.
Yeah, that time where Chris is mentioning is from January 21 to essentially for the year of 2021, when the market was just frothy about any car company developing an electric vehicle. And I know that's when GM started rolling out their first production of the electric truck. I forgot the name of it, but
The Lightning?
the Silverado is Ford Lightning.
Ford is Lightning, yeah, because it's the Lightning version of their
Yeah.
F series, right?
So it's similar to AI now, anyone who mentioned electric vehicle in 2021 saw a big pop in their stock prices, because you look at Stellantis and Ford during that time, very big pops as well.
So GM CEO Mary Barra makes $29 million a year. Ford CEO Jim Farley makes $21 million, and $21 million for Ford CEO Jim Farley, and then call it $25 million for Stellantis. So interesting. So Mary makes the most money. I wonder if that's because she has so many. Well, no, that doesn't make any sense. I was going to say if she has so many like claws and cliffs around that compensation to try to get company performance up. So they're trying to pay, but they wouldn't. They would pay it with all these, higher vesting schedules or higher strike prices and options and things. I mean, that's how Satya Nadella was compensated with Microsoft.
Correct.
He had all these huge. I mean, that's how Elon was compensated with his. He negotiated with the board and had these massive stock grants that were based on company performance, and in both cases, both of them hit those numbers.
Correct.
So we don't know if these are options or if these are RSUs, I guess, right?
Yeah, they're most likely options, but again,
yeah.
even the growth of GM over the last 10 years just doesn't justify 40% alone, right? So the compensation in terms of the number of shares probably had to go significantly up to get to that 40%, because
a lot more shares. Yeah,
it wasn't share growth, it wasn't profitability. It was, so what kind of financial hurdles did she have to meet? Because that seems like a very low bar to clear. In this case, it's a negative bar, because she actually actively lost the company money in the last 3 years.
Be interesting if she comes out and is a little bit more public and says like, yeah, I was awarded, $29 million, but I actually only got 6 of those million because of company performance or something. So I think it'd be interesting if she really unpacks that, to try to use that as a case to land somewhere in the middle. 40% increase, in reality, they probably land somewhere in the middle, 20. I don't know. I doubt they're going to get all of what they're asking for, but interesting nonetheless.
Yeah, and I think it exposes the gap between CEO and average worker, because at GM, the average hourly wage is about $21 an hour. And again, we could say a lot about union member performance, because I don't think they're the most productive workers on earth, but is she worth, given GM's performance, is Mary Barra worth what she was worth or compensated at the end of 2022?
Interesting. It'll be interesting to see how this unfolds, and the longer it holds, this will start to impact all of us with the price of cars and the inventory of cars, and maybe this causes inventory problems again for cars. Prices go up again, and we're back where we started. This could, in theory, lead to contributing to inflation once again, the longer that this lasts. So this will be interesting to see how this unfolds.
I have no doubt that the U.S. domestic production manufacturers would definitely see an increase in prices.
Yeah.
But I think we're in a position relative to 21 where supply chain is relatively much, much better. And people could go to Japanese makers, Teslas, or other non-big three related products, right? So,
because Tesla's not in the union, right? They fought that.
Correct, yeah.
Mm-hmm.
So there's no striking at Tesla. Mm-hmm. No striking from Toyotas or Hondas either. Mm-hmm. And I don't know if they can fill the gap, but still, it's just, I think it's worrisome for the U.S. auto industry that have been actively exporting their jobs too. And I don't know if the union really has too much of a leg to stand on, because a Mexican worker or a Chinese worker or South American worker can probably produce the same quality of car for a lot less money. And that's just kind of the ugly fact of wages here versus abroad.
It's be interesting because there's obviously this big push in the U.S. to bring manufacturing back onshore, chip plants, that kind of thing.
Now it's pushing back out, right?
And based on this, that could push things back out because of just cost and bottom line. And ultimately, if a CEO is trying to raise bottom line because that's good for shareholders and grow the company, that could then kind of change this trajectory. Interesting. Okay.
Yeah, Mary Barra needs to, justify her wages, her wage increases, right?
Yeah, absolutely. All right. Thanks, everyone, for tuning in. That's all the time we have today. We hope today's episode was helpful. And if you like our commentary, give us a like and a subscribe. And also follow us over on YouTube. I know that you can tune into this on YouTube and via any podcast platform. We have a number of different resources on YouTube. One thing that I think everyone would enjoy is our Consilio University feed. That includes 2 to 8 minute videos on super helpful financial planning topics, which is a deviation from what we talk about on this podcast, which is mostly top of mind media, top of mind news, and just trying to unpack the headlines for our listeners. So thanks again, everyone, for tuning in, and we'll catch you again in 2 weeks.
All right. Thanks, Chris.